Financial statement analysis. A strategic approach to corporate finance. Introduction. The power of financial statement analysis. Understanding financial statements is the foundation of corporate finance and a key competency for business leaders, investors, and financial analysts. Financial statement analysis provides insights into a company's financial health, operational performance, and future potential. By interpreting financial data, decision-makers can evaluate risks, identify growth opportunities, and make informed strategic choices. The intersection of accounting and finance is particularly evident in this area. While accounting focuses on recording and presenting financial data, financial analysis extracts meaningful insights from this data to guide investment, lending, and corporate strategy. At its core, financial statement analysis involves examining historical financial statements, identifying trends, benchmarking performance against industry peers, and making projections based on this information. This process informs key financial decisions such as investment evaluations, credit assessments, business valuations, strategic financial planning. This lesson will explore the fundamental techniques, methodologies, and applications of financial statement analysis in corporate decision-making. Key techniques of financial statement analysis. To conduct a thorough financial evaluation, analysts rely on three primary methods of financial statement analysis: horizontal analysis, also known trend analysis; vertical analysis, also known common size analysis; benchmarking, also known comparative analysis. Horizontal analysis or trend analysis. This method compares financial data across multiple periods to identify trends, growth patterns, and potential concerns. For example, tracking year-over-year revenue growth or profit margin fluctuations can reveal the company's trajectory and financial stability. Use case: if a company's expenses are rising faster than its revenues, it signals inefficiencies or financial risks. Vertical analysis or common size analysis. Vertical analysis examines the proportion of financial statement components relative to a base figure, e.g., total revenue or total assets. This approach helps compare companies of different sizes within the same industry. Example: if one company spends 50% of revenue on operating costs while an industry leader spends only 30%, it suggests lower operational efficiency. Benchmarking or comparative analysis. Benchmarking compares a company's financial metrics against industry averages or competitors. Investors and executives use this to assess competitive positioning, financial efficiency, and profitability. Example: a retail chain with a net profit margin of 5% compared to the industry average of 10% might need to optimize pricing strategies or cost structures. These methods, when combined, offer a comprehensive view of a company's financial standing and help stakeholders make data-driven decisions. Who uses financial statement analysis? A variety of stakeholders scrutinize financial statements, each with distinct interests and analytical approaches. 1. Investors and shareholders. Equity investors focus on long-term earnings potential, profitability trends, and dividend sustainability. Institutional investors and hedge funds may look for undervalued stocks to buy or signs of distress to short sell. 2. Creditors and lenders. Banks and financial institutions assess a company's ability to repay loans based on liquidity and leverage ratios. Bond investors and credit rating agencies e.g., Moody's, S&P, Fitch analyze financial statements to determine creditworthiness and risk levels. 3. Corporate management and executive senior management evaluates financial health, profitability, and efficiency to inform strategic planning. CFOs use financial statement analysis to set budgets, control costs, and optimize capital allocation. 4. Regulatory bodies and tax authorities. Government agencies and auditors examine financial statements to ensure compliance with financial regulations and tax obligations. Each stakeholder applies different techniques depending on their objectives, whether it's assessing investment potential, evaluating credit risk, or optimizing corporate strategy. Key financial analysis tools and ratios. To extract insights from financial statements, analysts rely on various financial ratios and models, profitability ratios or measure earnings performance, liquidity ratios or assess short-term financial stability, leverage ratios or evaluate debt levels and financial risk, efficiency ratios or measure operational effectiveness. The DuPont analysis. Profitability ratios. Gross profit margin equals gross profit/revenue times 100. Operating margin equals operating income/revenue times 100. Return on assets (ROA) equals net income/total assets. Return on equity (ROE) equals net income/shareholders' equity. Example: a company with a declining ROE may indicate inefficiency in using shareholder capital to generate profits. Liquidity ratios. Current ratio equals current assets/current liabilities. Quick ratio equals current assets, inventory/current liabilities. Example: if a company's quick ratio is below 1.0, it may struggle to meet short-term obligations. Leverage ratios. Debt-to-equity ratio equals total debt/shareholders' equity. Interest coverage ratio equals EBIT/interest expense. Example: a high debt-to-equity ratio signals financial risk but may also indicate aggressive expansion strategies. Efficiency ratios. Inventory turnover equals cost of goods sold/average inventory. Asset turnover ratio equals revenue/total assets. Example: if inventory turnover is low, it suggests overstocking or weak demand. The DuPont analysis. A deeper breakdown of ROE, showing how profitability, asset utilization, and leverage impact overall financial performance. Formula: ROE equals net profit margin times asset turnover times equity multiplier. Example: a company with high ROE driven by excessive leverage may be riskier than one with strong profit margins and efficient asset utilization. Financial statement analysis and business valuation. Financial statement analysis serves as the foundation for business valuation. To estimate a company's worth, analysts use historical data, financial projections, and economic forecasts. Key valuation methods: discounted cash flow, DCF, estimates a company's value based on projected future cash flows. Price to earnings, PE, ratio compares a company's stock price to its earnings. Enterprise value, EV, metrics assesses total company value, including debt and equity. Example: a high-growth tech startup may have a high PE ratio because investors expect future earnings growth, whereas a mature company may have a lower ratio. By mastering financial statement analysis, business leaders can make strategic investment decisions, mitigate financial risks, and unlock long-term value. Why financial statement analysis matters. Financial statement analysis is a cornerstone of corporate decision-making. It allows companies to assess financial performance and profitability, identify risks and opportunities, benchmark against competitors, make data-driven strategic decisions. From investors and lenders to executives and regulators, everyone relies on financial statements to gain insights into an organization's financial strength and future potential. By developing expertise in financial analysis, MBA professionals can make smarter investment decisions, optimize business strategies, and drive corporate success.